Okay, interesting speech there. I'd like to start off with a broad question for both of you. Within the current market environment, you've discussed quite a bit there, what is the best macro advice for investors, and are you seeing any changes in investment strategies based upon that? Start with
as I said earlier, the best thing to do is always stay invested. Cash doesn't give you a whole lot of return. For the last several years, it gave you a return less than inflation. The question is it's mainly more of a comfort level. You know, having assets to invest is a luxury. Not many Americans are able to do that, only about the top third. And it's got to be something that you're comfortable with. You don't want to have to worry about it. So that's my first key theme. So structure the portfolio how you're comfortable with. Basically, it breaks down into two different asset classes, those with a lot of risk and those with very little risk. Those with very little risk are like money market funds, CDs, bonds, that sort of thing. There you want 1 or 2 years lifestyle, more if that makes you more comfortable. And then the rest should be pretty well invested, and you're assuming a long-term time horizon of 5 to 10 years. For many people in this room, you know, you're all working. You won't need those assets for quite some time. Let them ride through business cycles, and then keep those assets, because when you take the money out, yes, you might be smart, but you know, very rarely do people put their money back in at the right time.
Thanks.
To echo that, we work with two types of clients: some that really want to have some input and some impact using some of their insight into their portfolio construction, and we see things all across the board, and that always seems to be the case, of the tail wagging the dog in many instances, where we've got people now that continue to want to move to more aggressive classes as they're chasing returns, the typical poor investor behavior that pops up, unfortunately, and we've got those that at times will read scary headlines and demand to move more to cash, which we push back on, but at the end of the day, we listen to our clients for certain. So for those folks, there's definitely a divergent approach all the time. Tends to be the case, but for clients that have us manage their portfolios on a per client basis, on a per portfolio basis, there's really not been any change. And to echo somewhat of what Paul says, you know, it's just a matter of if you've got a sound plan that was put in place that outlines all the issues related to risk management and income and security in down times, it's easier to stay on track, and that's what we really work to encourage clients to do.
Thanks. Next question for you, Paul. You briefly mentioned emerging markets in your presentation. Where do you see the investment opportunities available in that market at this day and age?
That's a good question. Emerging markets is a wonderful investment because when it does well, it does extraordinarily well. When it doesn't do very well. So it's far more volatile than other asset classes. So for portfolios that we manage, in general, it usually doesn't exceed more than 5% of the equity exposure. That said, as I mentioned, commodity prices have been falling quite a bit, and that's a big deal for a lot of emerging markets. But there's another issue that's going on in emerging markets, and that is that they've changed quite a bit over the last 20 years. They're moving upstream much more in terms of trying to create an economy much like the United States. They want to be very service-oriented. There's a large middle class that's being created in many of these emerging markets. And so what we focus on is investments that the middle class in those countries are buying. We want to stay away from commodities. That's too much. That's almost to us like trying to figure out where gold's going to be. Well, gold is a commodity, but you know, much more of a gamble. It's very difficult to derive consistent performance in commodity-oriented portfolios, but rather we buy stocks of companies overseas that, much like in the United States, that are very geared towards the middle class and the growing middle class and their consumption habits.
Great. Thank you. There was a recent national tax stimulus tax cut recently introduced and passed. How has that impacted the stock market and the economy? Start with John.
Yeah, there's no question it's been a tailwind. You know, one of the things that we do is get a lot of great research from groups like City National Rockdale, and they've got a great slide that Paul wasn't able to get in. It was on the 3.5-hour portion that you weren't able to get to today. But one of the big things that they've put out there is that this tax reform, lowering the corporate tax rate, probably is going to add 8% in earnings growth to the S&P 500 by year end. Some of that has been realized but a lot of the growth has been limited to certain sectors at this point. We do still believe there's strong opportunities in dividend-paying stocks, large cap value stocks in the near term. Really haven't seen the kinds of runs that the growth stocks have seen in a couple sectors of aerospace and technology. So there's no question that the tax implication has had a big impact, and some of those industries are very U.S.-centric, so they're seeing the largest tax savings, so that's definitely been reflected in their share price. In terms of the economy, on that front, the issues that tend to be in the news right now are all about tariffs. There's a lot of dialogue on that, but GDP is strong. It's continuing to increase. There are some changing dynamics, as Paul mentioned, with the millennial population, but the reality is, from their research and other groups that we follow, should all of the threatened tariffs come about with China, that really represents a very small portion of our economy and a very large portion of theirs. And with that dynamic, what that creates is, really a negative 0.2 to 0.4% drag on GDP. So economically speaking, we feel like we're in a good place. And with rising wages, consumers having more money to spend is a good thing. Now we'll have to see if that translates into their willingness to spend and continuing this economic growth.
The other issue is in terms of the tax cut for businesses, especially small businesses. I mean, a lot of the research deals with the S&P 500 because that's where people invest. But for small businesses, those that are defined by 50 employees or less, this is a pretty nice gain for them. And as a result, it's created a great deal more wealth and more money to spend. The other issue, especially for the bigger companies, is the fact that they're much more willing to invest in their own companies than before. And that, of course, will drive growth over the next several years.
John, this one's for you. As your organization interacts with regional business leaders, what are the most common issues that come up in your conversations with them?
Yeah, I think the dynamic of an aging leadership population, with the boomers having built meaningful enterprises and organizations, we are seeing two fronts. One's related to that dynamic, and one's really not. It's more regulatory in nature, but succession has been a conversation that we've had much more frequently, and we are seeing people initiate those conversations. And we're also seeing a number of clients and people that we talk with executing succession plans. And one of the things that's been most encouraging to me about that is as this trend increases based on the aging leadership that's out there, it's really creating a number of different opportunities. One, it's creating new opportunities for smart, younger leaders to step in and fill roles that those executive leaders had filled. So we're seeing that be a really good opportunity for that middle-age market to really step into more meaningful strategic involvement in company direction. And the leaders that are planning those exits are really being what I feel is much more thoughtful and strategic about leaving the organization in as good a shape as ever been, not just mostly so focused on their exit and their personal financial situation. So that's been very encouraging. The other front that we've had a lot of conversations brought to us on is in terms of the fiduciary standard that was put out there by the Department of Labor on qualified plans that recently the Trump administration has mostly vacated those issues, but that conversation is still definitely in the public discourse. And that fiduciary standard is something that plans have started to really recognize as being a real risk to their business. There's been some major lawsuits that employees have won over their employer plan sponsors, where the employer plan sponsor really didn't do a great job of fulfilling their fiduciary duty in helping minimize costs inside the plans, helping to ensure appropriate low-cost investment options are available. So those have been some real risks that we've seen business leaders and business owners be concerned with, and the industry has really responded well in providing many different types of methods for those plan sponsors to shift that risk to financial institutions that have a much better background in being able to make available high-quality investment options that are definitely at lower cost, which is definitely good for investors.
Thanks. Paul, in your presentation and your discussion, you talked a little bit about emerging markets. On a little deeper dive into foreign developed markets, they've not performed well recently. Why is that?
Yeah, when you talk about foreign developed markets, generally you're talking about Europe. Europe's approach to this recession is much different than the United States. They went into the same Great Recession that we did. Their GDP fell 5% year over year, just like ours. Their unemployment rate went up to 10%, just like ours. But when we tackled the problem, we were very fortunate to have Ben Bernanke, who was head of the Fed at the time, who studied the Great Depression and how to fix the problems from the Great Depression. So he came in and secured the bank. Well, the Treasury Secretary said, because people are taking their money out, and there's not nearly enough currency in circulation, so we've got to put a stop to that. So he says, we'll guarantee all the deposits at the bank. Don't worry about the FDIC limits, but I'm sure you remember, he doesn't have the authority to do that. He had to get Congress approval a few days later. But we did that. They pushed rates down to near zero. They did quantitative easing, which pushed down longer term rates. I mean, car loans went from 8% to 4%. That's an incentive to buy. And then there was a stimulus package. Europe has a different approach to issues. The European Central Bank is based in Frankfurt. The head of the European Central Bank was German at that time. If you think their history, what's their worst economic catastrophe? And that was the high inflation of the Weimar Republic. They didn't want that. So in 2009, 2010, 2011, and oil prices start to go up to $100 a barrel, they raised rates, put themselves in a second recession. Quickly, they came out of it, and then they had to deal with the sovereign debt crisis with Greece. They just had one problem after another that they didn't manage that well. The outlook going forward, the big problem mainly is Turkey, talking about another emerging market where it's a problem. Their currency has fallen to about 30 or 40% this year. They've spent way too much money, but the big problem for Europe is that they lent them a lot of money, so the European banks are in serious, it looks like they could be in very serious problem. And that was the other thing that we did, that we made our banks extraordinarily safe, required capital requirements to move up. They didn't do that in Europe. So now it's really starting to hurt them.
Thanks for an excellent answer. John, please share with us what you're seeing in the financial advisor investment marketplace as it relates to both fees and services.
Yeah, the regulatory environment, again, from years back, the Obama administration introducing the fiduciary standard has had a real impact in our business. While some things don't change in our business at all, appropriate risk taking, appropriate asset allocation, this has been an area that's been a real trend shift in the advisor community and in the way financial services are delivered. And it's all been very good for the investor. In spite of the fact that the regulation has now been pulled back, there's still big conversation in the public marketplace about how investors should best receive financial advice. The trend has really been to, and what the trend has created really three different categories of advisory services as advisors and as financial institutions have shifted to meet those new realities. The benefit for you guys as investors that participate in that is the first one is you're going to see lower fees across the board, and more importantly, you're going to see the fees. Transparency is a big impact. So that investors can be more informed, they can ask better questions. But when they're working with advisors, we think it's real important that people really understand that there's really been a creation of three different methodologies of delivering financial advice. Now, distribution has changed over the last 3.5 years significantly nationally, and that's moved to they're still sustaining the traditional model of insurance investment brokers. Whose job is to find great products and recommend them to clients. It's not really an advisory role. It falls under a suitability standard. So those folks are recommending products and services, not actually providing advice, earning commissions, which is fine. It's been the business model that's existed for years and served a lot of people well. What the other trend is on the fiduciary model, there's really two different types of advisory services that have strongly emerged. One is a fee-only type of setting where advisors will very clearly detail and identify what their value proposition is so that consumers, investors can see, okay, this is what you're doing for me on a line item basis, and this is how you're charging me. It's very transparent. And it's a very good solution for investors. The last model, the fiduciary standard, are what are being labeled hybrid advisors. Hybrid advisors are those that will serve as a fiduciary for investors, making sure that the advice that they're recommending is in line with what is best for you, the consumer, but they're either charging fees for their time, their service, their plans, or investment management, and they also have the ability to offer commission-based insurance or investment products, so long as fiduciaries, they've fully disclosed how they're compensated on all fronts. So the benefit to investors is truly, over the long term, there's a lot of government statistics, most of which I believe, about how big of an impact that can have for investors over the long term, not only having lower fees, but getting more clarity on what value you're being provided and having all that be much more transparent.
Thanks. In the last 2 or 3 minutes we have, I'd like each of you to provide some closing comments to send our crowd out into the investing world as they leave.
Well, the first one is maybe a little bit off color for this crowd at 8:30 in the morning, but we use a term we've heard, we didn't coin it, from other folks in the industry, to watch out for what we call, or has been called, financial pornography. It's very exciting to look at. The reality is it's cable news. It's a lot of talking heads talking about all kinds of things. And what we always tell folks is, look, everybody is always selling something, and the financial media is selling something as well. They don't have any incentive, pro or con, in the recommendations that they're making, other than to incentivize you to keep your eyes glued to themselves. And the best way that they do that is through fear. So you've got to understand that the financial media is always marketing fear to keep you watching, so that you'll see the commercials of the people that are also trying to sell you stuff, which they've sold the airtime to. So we really encourage folks to do a couple different things. One thing that's really been a growing field that people need to understand is behavioral economics and the biases that investors typically aren't aware of that they have. So if that's something that you want to write down to learn a little bit more about, to be a more successful investor, is to go really understand investor biases that are behavior driven. It's all human psychology. That's really an interesting field. But make sure you're also in your investments working to ask fair and honest questions. You don't always need to have the lowest cost option, but making sure what you're paying is a smart thing to do. And then look to be strategic as you make decisions with your investment advisor, or on your own if you're doing it yourself. Buying low and selling high is the name of the game, which definitely sounds easy, but doing it in a disciplined way over time is where the magic happens. So I'd like to encourage you with that.
Thanks.
I think you bring up a very important point, is trying to separate the difference between noise that you hear all the time versus what the trends are. And by and large, the trends are quite good for the United States and investing in the United States. There are different areas that you can invest that we talked about, but you want to stay invested, and that's the key thing, because that's going to be how you can create wealth over the longest period of time. Again, if you don't have a lot of comfort with this sort of thing, then buying a large index fund will get you 80%. I mean, you're moving with the tide. It's when you get invested in the different smaller sectors where you can have the possibility of making more, or you run the risk that maybe you don't. But you do want to stay invested, and that's the key thing.
Thanks to both of you for excellent investment advice in a very short period of time. Thank you all.
Thank you.
Thank you. Appreciate the opportunity to be here.